Hello, and welcome to a new release of Fitch Ratings Virtual Investor Meeting Series, this time on European covered bonds. My name is Juan Garcia, a member of the analytical team based in Spain. With me is Vesela Kremsec, based in Frankfurt. She leads the analysis of covered bonds for the Central and Eastern European region, and Beatriz Gomez, who is based in Madrid and leads the analysis of Spanish covered bonds called Cédulas. Let's kick off. The European covered bond harmonization project began some years ago with a directive that was approved 18 months ago. And this month, in July 2021, is the deadline for the transposition of the directive into national law across the continent. So, Beatriz, in few words, what is the status of that transposition across European countries?
So Germany is the only country that has completed the transposition on time. And actually, the first set of changes came into force on the 1st of July. Then the rest of the countries that you can see marked in yellow on the map have missed the deadline, but they're making progress. And in this sense, the latest development comes from Spain, where the draft law transposing the directive was published a few weeks ago and is currently under public consultation.
Okay, so most countries saying amber color, moving along with Germany completing its task already this month. Great. Just to set the scene, can you remind us of, let's say, 3 core principles of the directive that are most relevant for the analysis?
So one is the harmonized liquidity protection to cover the net liquidity outflows of the covered bond program over the next 180 days. Another are the harmonized extendable maturities subject to objective triggers. And the third principle is the introduction of the figure of the cover pool monitor and also increased supervision.
Okay, thank you. So strengthening liquidity, the possibility to do maturity extensions and cover pool monitoring. Understood. Right, let's go to Germany. Vesela, hi. We just heard Germany completed its transposition on time. So what key developments do you want to highlight?
Yes, the most important change is the introduction of a 12-month maturity extension feature. Pfandbriefe have been known as a hard bullet instrument during their long history, and now, since the 1st of July, the soft bullet feature will not only apply to all newly issued Pfandbriefe, but also to all outstanding bonds. And another important development to mention is that Pfandbriefe continue to benefit from the 108 days liquidity buffer. There were a lot of discussions during the consultation period with the Pfandbriefe issuers who would have preferred, if the calculation is amended, to be based on the extended maturity of the bonds. However, the calculation remained unchanged and is still based on the expected maturities of the bonds, offering larger protection for investors. So although maturity extension feature is now in place in Germany, the protection by the 180 days liquidity buffer was not weakened.
All right. But you introduced the soft bullet amortization profile, which is a game changer considering the long history of hard bullet German Pfandbrief. Okay.
Yes.
And you mentioned that these changes apply retrospectively. So it's not only for new issuances, but also for all outstanding bonds. So the burning question from an investor perspective, how is the market taking on this feature?
Yes, well, soft bullet covered bonds have become the market standard. So most investors are seeing the changes as strengthening the German framework, and they appreciate the fact that the extension of the maturity is not triggered automatically, but is conditional on the covered bond administrator expecting that the extension would lead to a more favorable outcome for the bondholders. So it is all in the interests of bondholders, and therefore it is not surprising that there has been no disagreement on that in the market so far.
Okay, and the last small question, the German covered bond typically is AAA rated, so I guess there's no rating uplift potential, but from a, let's say, fundamental analysis, what are the implications of this development?
Yes, exactly. There is no rating impact from the law amendment because, as you said, most of the Pfandbriefe are already rated AAA, but there is now more buffer against issue downgrade, which means that the Pfandbrief ratings are more robust. And for 2 of the Pfandbrief programs we rate, the changes also reduced the over-collateralization levels for the respective ratings.
Okay, understood. So greater protection. Great. Let's go back to you, Beatriz, in Spain. The Spanish Cédulas market, the Spanish typically mortgage covered bond is very large, more than 200 billion of outstanding. And you just mentioned that the draft bill was released a few days ago. So what are the highlights of that proposition?
Mm-hmm. So the draft law introduces the 180-day mandatory liquidity buffer. Another change is that it gives the option to introduce soft bullet maturities, although it's not explicit regarding the timing of the extension. And as you can see in the slide, soft bullet maturities are becoming the norm in Europe. Actually, as of July this year, around 80% of the European covered bonds rated by Fitch will have this type of maturity profile, and only around 8% will continue to be hard bullet, which mainly correspond to the Spanish programs and a few outliers. So if this change is finally implemented in some of the cédulas, it will definitely be a game changer for the framework.
All right, so soft bullet being a game changer, but we just need to wait and see if there is greater definition in terms of the length of the extension. Okay, understood. On the other side, what about over-collateralization? And I ask this question because the Spanish covered bond market has typically been the most generous one in terms of offering greater security package with at least 25% minimum over-collateralization, which is much higher than international peers. What is the draft bill suggesting on that front, Beatriz?
So the draft law does not set a minimum expectation of OC, and mainly it leaves it on the hands of the issuers to define it on contractual basis. So as you highlight, this is a material change. As you say, in Spain, we have a minimum legal OC of 25%, and most of the issuers maintain OC levels even much higher than this level.
So it's a bit of a tricky situation because they are suggesting great improvements on the liquidity front with dedicated liquidity, the possibility of soft bullet extension, but then on OC, there's like uncertainty because that famous 25% is not being redefined with a concrete percentage, and we just need to wait to see what issuers on contractual basis will define, or also clearly changes to the draft bill when it comes to its final shape. Okay, so with these moving parts, almost like in opposite directions, what could happen to ratings?
Well, in our criteria, the existence of liquidity does come with higher rating uplifts, but the ultimate rating upgrades will depend on the, as you say, on the existence of sufficient OC to offset the higher stresses that we expect in the higher rating scenarios. As a reference, a program to be rated in the investment grade, for example, a single A rating category, would need to have sufficient OC to cover losses that are estimated in the range of 10 to 15%.
Okay, so OC sufficiency is the critical bullet point here. Okay, great, thank you. Let's go back to Vesela in Frankfurt. So as the process keeps on moving along, one country completed its transposition, various other countries moving along, but let's say getting closer to the maybe transposition being a reality. What would be, from a big picture perspective, the obvious risks that covered bond investors have to monitor going on?
Yes, there are maybe two points to mention. Firstly, the calculation of the 180 days liquidity buffer, as we already talked about how it could be structured. So the EU Covered Bonds Directive allows for national discretion when implementing this buffer. So either its calculation is based on the extended maturity of the bonds or on the expected maturity. It is just one word. However, the difference for the liquidity protection is significant for investors, and they should pay attention to what the calculation is really based on. And another point in this connection is that in some jurisdictions, the introduction of liquidity protection by law may lead to issuers removing the existing contractual liquidity measures, so that some covered bond programs might end up having weaker liquidity protection than before the implementation of the EU Covered Bonds Directive. So here as well, investors should really pay attention to the details.
Thank you. Yeah, makes sense. So it's almost like a control F find function to see whether it's expected maturity or extended maturity. It's only one word, but it's critically important. Thank you. And Beatriz, with so many changes being suggested by the draft bill in Spain, and in theory, the directive should be implemented next year, July 2022. What are the expectations, let's say, at the issuer level in Spain to be able to introduce so many changes?
Well, the draft law has an expectation for the existing cédulas to adapt to the new terms by July 22, which, as you say, is the deadline of the directive for the implementation of the changes. But obviously, there could be some timing constraints given we've just seen the draft law. Let's see when the final law is approved, and then the issuers will need to adapt. And in the Spanish case, it's different to the German case, for example, as it will require a lot more proactivity from the issuer side, as they will need to set up the liquidity buffer, which is not there right now. We have hard bullet maturities with no liquidity at all. Then they will also need to set up the cover pool monitoring. And another relevant change that we haven't mentioned until now is that the cover pool will be redefined. Currently in Spain, the cover pools are defined as the entire mortgage book of the issuers. And now we will shift towards a much more defined perimeter. So they will need to select what assets actually go into that final cover pool. So yes, a lot of changes coming up in the Spanish front.
A lot of changes, and then by interpreting your words, it applies retrospectively too. So all outstanding Spanish covered bonds have to migrate to the new law, which is a significant migration task. Mm-hmm. Thank you very much, Vesela and Beatriz. We leave it here. And thank you all for listening. If you have any question on any of this topic, please drop us an email. Our email addresses are appearing on the screen. Thank you. Goodbye.